And to discuss this in greater detail, we now have a panel joining us on the show. Mr. Sunny Agarwal, Head of Research, Fundamental Desk at SBI Capital Securities. Mr. Narendra Solanki, Head, Fundamental Research, Investment Services at Anand Rathi Share and Stock Brokers. And Mr. Pranav Haldia, MD, Prime Database Group. Gentlemen, thank you so much for taking your time out and joining us here on ET Now. And Mr. Haldia, let me come to you first then. How would you describe primary market action in calendar year 2025, and what, in your opinion, is driving the renewed momentum in primary markets? Is it liquidity, is it earnings visibility, or just global risk-on sentiment that continues to aid primary markets?
Thank you for having me. So as you said in the introduction, this was a record year for IPOs. We've had 102 IPOs thus far, with 1.75 lakh crores being raised. And one interesting aspect to note here is that, this comes on the back of 2024, which was also a record year. And actually, this is the first time in India's IPO history that you've had all-time high record years. You've typically seen that, one all-time high year is then succeeded with, 2 or 3 tepid years. But, this shows the kind of activity which is taking place. Of course, the pipeline, there is an amazing confluence of supply and demand which you are seeing right now. And the supply of issuers coming to the IPO market is essentially on the back of demand coming in from domestic institutional investors. As we know, retail investors are pumping in on a month-on-month basis through SIPs, and all that money is actually finding its way, into the primary market as well. So that's really the main reason why you're seeing this supply of issues. And you've seen all kinds of companies from various different sectors, different sizes hit the market. You've seen the new age technology companies, the startups which have come to the market. You've seen MNCs listing their subsidiaries in the market. And at the same time, you've also seen your traditional Indian promoter, your manufacturing and industrial businesses coming to the market. And the reason for all of it is common. The valuations which they are getting in the primary market are extremely attractive, and this is what is fueling, the supply. In fact, the pipeline as we speak, in 2025, you've had 247 companies filing their offer documents with SEBI. So, all things considered, 2026 looks likely to be a record year as well.
Okay, so 2026 is also expected to be a record year. That's the word coming in. But Mr. Solanki, coming to you then, several renowned investors have also recommended caution on primary market euphoria. Would you agree that investors should perhaps be cautious instead of being swayed away by broader market euphoria? And there is also a lot of chatter around mutual fund buying in select IPOs, even when valuations recommend otherwise. Your thoughts on this?
Yeah, in terms of valuation, if you ask me, so definitely the multiples have what we have seen right now for the IPOs have been on the higher side if you compare it with something with 5 years back. But I think I would like to use a different word. Instead of caution, I would like to say that investors should always evaluate each and every IPO. And this exercise should be done by each and every person, keeping in mind his own return expectation and as well as investment horizon. Definitely study is one of the premise for investing into any IPO. Now coming to the valuation part, so broadly we have seen that IPO market in India has structurally changed over the years. Earlier we used to see a lot of companies which were which were operating into some kind of physical kind of a sectors like manufacturing. Either they were producing some kind of a product related to B2B segment or maybe B2C segment. But right now, what we are seeing is that a lot of companies are coming out with an IPO which are more technology oriented, and they have a software kind of a product or services a kind of a product. So this has been a structural change, wherein larger part of the IPOs are of the companies which are more into, I would say, services sector or software as a services kind of a sector. Hence, there is a shift in terms of business model as well as shift in valuations as well, because these kind of companies tend to have very high leverage benefits going ahead whenever they are into a high growth path. then the leverage benefit which drives the bottom line is very huge in these kind of companies. Hence, there is some sense as well in terms of why these IPOs are coming at higher valuation. But yeah, definitely we have seen over the years the valuations tending to go on the higher side. So that is the factual data. But I think we have to also find out the reasons and then study all the IPOs independently and then maybe deciding on each and every IPO whether to invest or not would be a better exercise to do.
Okay, so you should study each and every IPO independently. That's the advice coming in. But let's keep the discussion going with respect to valuations. And Mr. Agarwal, do you believe IPO valuations have become more aggressive in 2025 compared to prior years, or is it that is it the other way around? Are high valuations leaving limited upside for investors whenever they subscribe to an IPO? What is your view when it comes to valuations?
Thanks for having me on the show. I think valuation again is subject to the kind of business or sector from which the company is seeking fund for. But overall, if you look at a broader valuation metric, I think as we speak, most of the companies are either coming at a fully discounted valuation, and hence there is a very limited upside on limited upside for a new incoming investor, and that is the reason you see that. I believe if you look at the data, I think 50% of the issues this year would have listed below the issue price, and maybe 50% would have given a return on the listing day, and post that the trend has continued. So I think that clearly shows that valuation is something which is not very attractive for each and every issue. Again, that depends on the kind of business or the sector from which the company is getting listed, and what are the peer companies which are trading within that sector, what are their valuation in that respective sector.
Okay, so that's the view when it comes to valuations. But Mr. Haldia, coming back to you then, what is your view when it comes to listings? Is there a concern over high number of mediocre listings and weak post-IPO performance? Because usually we see a lot of euphoria when the IPO is launched and when it gets listed, but generally it fizzles out later. What is your view when it comes to this trend?
Well, I have a slightly different view on this. I feel that any kind of analysis of IPOs 1 month later, 3 months later, 6 months, or a year later is an exercise in futility. A company after it IPOs and gets listed, it becomes like any of the 2,500, 3,000 companies that we have listed on the stock exchange. And the share price will move up and down on the basis of how the company is doing, how the sector is doing, how the broader economy and markets are doing. So at most, one can look at the day of listing and the closing price on the listing day to get a sense of how the IPO was priced. And the reason for that is very simple, that is the day when the share becomes widely available for trading by all kinds of investors, retail or institutional, domestic or foreign, long and short. But to do any kind of analysis subsequently, and you can take countless examples, even talking of the technology companies which we were just discussing a while back, which have hit the market in the last 4 or 5 years. You've seen absolutely different, price performance subsequent to the IPOs. And mind you, several of these which have given superlative returns at the time of IPO, there was a lot of commentary about their high valuations as well. So, it's ultimately to the credit of the company and how it's performed subsequently that it's, the share price has gone up. But even for the sake of argument, to answer your question, that if one were to do this analysis subsequently, and is it true that IPOs only give, a return on listing and subsequently all fizzle out? The data actually shows slightly, different outcome. If you look at IPOs which hit, from 2018 onwards till calendar year 2024, so a 6-year period, on an average, IPOs have given absolute returns of 227, 172, 95, 65, 18, 27, and 10% respectively for these 7 years. So on the whole, IPOs have continued to deliver positive returns even till today.
Okay, so that's how historic performance has been post-listing. But Mr. Solanki, coming back to you, and let's talk about Outlook 2026. Which will be that one segment or one IPO that you will be watching out for? And by any chance, will it be Reliance Jio listing that everyone is waiting for?
Definitely, there are a lot of big IPOs which are lined up, and Reliance Jio being one of them. So definitely, market would be keeping an eye on at what valuations and what pricing the IPO is coming out. And likewise, as far as sentiments are concerned, I don't see any kind of there is any risk to the overall sentiment of the primary markets. There may be some timeline issues like we have seen this year, like first half was very patchy and very slow in terms of primary markets, and the real pickup happened post August in second half, wherein we have seen monthly run rate of around 10 to around 20 to 15 kind of IPS, and especially in September, October, November, December, in last 3 4 months, we have seen a lot of IPOs actually coming online on a weekly basis. 3 to 4 IPOs are coming. So I think sentiments would remain as is, and they don't see any much of a risk.
Okay, and Mr. Haldia, coming back to you, how is the IPO pipeline for 2026 looking like in terms of quantum? I understand it's difficult to predict at this point in time, but basis the data that we have so far, do you think 2026 could actually break all records?
Well, it's obviously very hard to put a number to it. And historically, over the last 35, 40 years, we've seen that, the primary market takes a cue from the secondary market. And even this year, you made a point earlier about secondary market giving only 7 or 8% in this calendar year. But, let's be clear that for the first 3, 4 months, when there was excessive volatility in the secondary market, the primary market had completely dried up. In March, I think you didn't see a single issue coming at all. So, and only after April, when the tariff concerns started being put to rest and there was a run up in the secondary market, that you started seeing a rub-on effect on the primary market as well. So, my expectation is same for 2026. I think for IPOs to happen, you need a stable or a buoyant secondary market. So, unless you have a black swan event or something which causes a major correction in the secondary market, you should see a huge number of listings. I already mentioned that 247 companies filed their offer documents this year with SEBI. The pipeline, as we speak, there are 194 companies which are already holding SEBI approval or are awaiting SEBI approval, looking to raise 2.6 lakh crores. And this is what we call as the immediate pipeline. And this, of course, like you mentioned about the Geo IPO, this doesn't include that. It doesn't include NSE, Zepto, Flipkart, some of the other large deals which are expected in 2026. So I think as long as secondary market conditions remain stable, you will see another record year for IPOs.
Okay, so 2026 could be another record year for IPO. That's the word coming in. But Mr. Agarwal, is the focus shifting back to profitability now over growth, especially for newly listed companies, unlike the last few years where the focus was only on growth, even at the cost of profitability?
I think again, as an investor, secondary market investor, and IPO investor, obviously the focus will be on sustainable, profitable growth. Even if we look at the new age businesses which are making PAT losses, ultimately aspiration of any institutional or retail investor is to see the profit or at least path to profitability, and company walking the company's ability to deliver on that path to profitability. I think ultimately, as an equity shareholder, obviously, I would I would love to see the healthy return on equity in my investment portfolio, and that will continue to remain the mainstream investment framework, whether it is an IPO market or the secondary.
Mr. Solanki, if we see a lot of IPOs in calendar year 2026 yet again, do you expect liquidity to drain from secondary markets and shift to primary markets?
See, generally, it's not like that happens. However, you have to look at it's a very short term. Like so, any big IPO which is coming in, So right now we have enough liquidity in the markets overall. And if you see the retail investors flows, especially in SIP flows, if you track, so they are consistently more hovering between 25,000 to 30,000 crores. So liquidity is ample for decent size of IPOs, and do not see the secondary market reacting because any large IPOs are coming, and then we see any kind of a liquidity draining kind of event happening. But yeah, on a broad view, if you see whenever any large year happens, wherein we see a lot of IPOs like in 2025, 1,25,000 crores of IPOs have on 1,60,000 crores of IPOs we have crossed. So there might be some short-term reaction to it, but do not see any medium to long-term impact on the secondary market because of the high amount of IPOs coming in the market.
If I can just add to the liquidity point,
Sure, sure.
I think this year you had two large issues coming together of LG and Tata Capital, and there was again a lot of commentary around that time that it would suck out the liquidity from the secondary market. But if I remember correctly, the indices went up by 5% in that very week. In fact, even if we were to look at the post-COVID era, you've seen a record amount of funds being raised in the primary market, and yet secondary markets reaching all-time highs. So I think there is enough liquidity, and recent IPOs, including just the ICICI Prudential IPO, which I believe has attracted applications worth 4 lakh crores, shows that the amount of money which is available to be invested. I think what is important for both primary and secondary market is good quality paper at attractive valuations, and that will create its own demand.
Okay, and it is not likely to have a big impact on liquidity of secondary markets. That's the word coming in. But Mr. Haldia, if you can take us through one big IPO that you will be watching out for next year.
Well, so I don't comment on specific IPOs, but like I said, I think Geo, of course, just by the sheer size expectations that we have, that would be something interesting to watch. I think you will also see a lot of these new age technology companies or the startups which will hit the IPO market in 2026. Just by we've been compiling the data of several of these startups which have announced IPO plans in the future. And these are ones which have not yet filed with SEBI or are not holding the approval already. There are 83 other such startups which are going to raise around 1.5 lakh crores, which are looking at an IPO in the next 1 to 2 year timeline. So I think that's going to be a very exciting space to watch.
Okay, we've already seen a lot of IPOs getting listed on the bourses over the last few years, and probably that trajectory is likely to continue going forward as well. Mr. Agarwal, let's talk about the challenges that the industry faces in pricing IPOs. What do you think is the biggest challenge? Is valuation a problem? Is it global volatility, or just FPI's hesitation while venturing into these new IPOs?
I think again there seems to be no challenge as far as IPO is concerned. The kind of pipeline we have seen in the IPO, and obviously as a process, merchant banker and promoter do have a soft check or maybe a kind of during the roadshow they keep on interacting with a lot of QC. And after a lot of discussion, I think the price of an IPO is decided. So I think one there is a good response during the roadshow, and that's the basis on which the IPO or issue prices are decided. So I think there is no challenge as such till the time we see any failure in terms of any IPO not getting a good response in terms of subscription level. I think most of the IPOs are getting subscribed, and in fact multiple times, especially good businesses are getting a phenomenal response. So I don't think so there are any challenge as far as IPO markets are concerned.
As far as challenges that the industry is facing. But Mr. Solanki, coming back to you, are we seeing a disconnect between private market valuations and IPO pricing? So private market valuations are perhaps softer than the IPOs at which that they get listed?
I think both set of markets are completely different. Private markets, there are very less regulations, and there are a lot of risks involved. Also, in private markets, one key thing you have to note is that people are who are those who are putting in money are very seasoned professionals who are operating in this market. Plus, they are taking a huge risk because at that moment, whenever any company approaches a private player for funding, those companies are generally into very early stages, and the probability of getting success in their businesses are very low. Those companies tend to have a very slim or almost a negligible profitability. So the complete risk reward equation is completely different in comparison with the secondary markets. Hence, I think the valuations also is different, and the metrics of valuing those companies at very early stages are different. So in hindsight, we may see that okay, XYZ company was valued at X times 2 years before, but right now it is coming with an IPO which is more than 5 times its valuation. So what changed in those 2 years? So in hindsight, it may look like this, but if you really go back in the time and see and analyze the kind of performance and the kind of risk those players were taking, then you would probably realize that the valuations at that time were maybe appropriate for that kind of risk and reward scenarios. So I think because of all these different factors, valuations do tend to differ. And in secondary market, there are a lot of transparencies involved, disclosures involved. Companies need to update on the business on a quarterly basis because of regulations. Plus, they have to disclose all material information immediately to the exchanges. So these kind of things makes very easy for a general investor to track those companies, which is not available to investors in the primary market. So all these factors come into play while valuing the company in primary market. So hence there is a difference.
So those are some of the latest trends that we are seeing in the primary markets. Mr. Haldia, Mr. Solanki, and Mr. Agarwal, thank you so much for taking your time out and joining us on this special show on ET Now.
Thank you.
Thanks so much for joining us.
Thank you.